We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Pento from Pento Portfolio Strategies. How are you today, Michael? Thanks for joining me.
Always a pleasure to be with you, Tom.
So I wanted to start by asking you, is the nation now insolvent?
Yes, I think it is, unfortunately. It's a great way to start the show, Tom. Wow. I mean, you know what? Assets minus liabilities, you look at that, it's insolvent. The revenue they're generating now in relation to their debt, there's 730% more debt than there is revenue, and which is a huge problem, Tom. But when you think about it, if you're adding to that debt, 40% of the whole revenue is being added to the debt because the deficits are huge. You know, $2 trillion deficits. It's 40% of our revenue. So it's not like you have, this massive overhang of debt in relation to your revenue, but you're paying it off slowly. You're adding to it. Mm-hmm. You're insolvent. And that's a direct result of, 20 years of interest rate repression to the point where the Fed funds rate minus CPI has been negative for 20 years, 2002 to 2022. That has never, ever before happened in the history of the United States. When you borrow money, you're supposed to get paid above inflation. Otherwise, what's the sense of saving money? Why would you say, Tom, if I said, hey, give me money, I'll give you money, at 2%, and and inflation is at 3%. Well, I'm a loser. But that's what's happening. Doesn't make any sense.
Mm-hmm. So, as part of that, Michael, you mentioned that basically that real interest rate. Does that mean also that the monetary fuel is starting to be shut off to the economy?
Tom, that's exactly what it means, Tom. If you look at the Fed's balance sheet, it's gone. I mean, it went parabolic from 700 billion to 9 trillion. Now it's $7.2 trillion. So the base money supply is being attenuated. Bank lending standards are tightening. Percentage of banks tightening lending standards is increasing. And the reverse repo facility went from 2.5 trillion to now it's just about $350 billion. So that fuel is drying up. The yield curve is inverted. It's been inverted for a record amount of time, which means, basically, first of all, banks aren't lending a lot of money because nobody's buying a house. No one's borrowing money. It's all cash deal. No one's going to trade their 3% mortgage for a 7% mortgage. So there's no, and the bank's legacy assets are yielding them 3.5%, but their funding costs are 5%. So there's just not a lot of money being created, and asset bubbles that are this exaggerated. Stock market is 200% of GDP. Home prices are 5.5 times incomes. Those asset prices don't remain where they are unless there's a ton of new money, jet fuel, rocket fuel blown into them, and it's just not happening. It's the opposite happening. So reality is about to hit, my brother. Mm-hmm. And you look at the credit bubble that we have. I mean, private credit was something that didn't even exist a few years ago. Now it's in the trillions. Collateralized loan obligations, very small a few years ago. Now it's trillions. So we have a business debt to GDP is higher than it was going into the great global financial crisis. So we got problems, Tom.
Mm-hmm. Well, as you say, we're facing all of these problems, and it doesn't seem like, it's relegated to only one sector, that being, .com stocks or the mortgage market like we saw previously. It seems like this has just been kicked upstairs. But one thing I did want to touch on with you before we move on from that is the credit spreads that you mentioned, Michael. Are they starting to widen, and what does that end up meaning for liquidity? And does basically the entire market and economy really rely on that liquidity to be at these elevated levels?
Well, to answer your question, amazingly, the credit spreads that I look at and the financial conditions I view are still quiescent. There's a slight erosion in the triple C to high yield, but to investment grade. But what I look at is treasury to high yield. That's my major focus, because when you think about that function, and no, it's not different this time. If the economy was truly, really going to fall off a cliff, and I think it will, it's just not happening at this moment. Let's not use hyperbole. Let's try to be honest here.
Mm-hmm.
What would happen is that people would say, okay, the economy's falling off a cliff. My high yield bonds are going to default. I'm going to sell them. The price goes down, the yield goes higher, and I'm going to put my fixed income sleeve allocation into treasuries. The price goes up and the yield goes down. The spread blows out. That has always happened. It will always occur. It is not different this time. When it happens, I'll know about it and I will take action and we'll start shorting the market. It's just not happening yet.
Right.
It stopped, Tom. Credit spreads stopped compressing a few months ago, and they have to stop compressing before they widen. So that function's happening, but the financial conditions are still easing. Credit spreads are still quiescent. So I'm not ready to, short the market yet, but I'm ready to do it.
Yeah, you must be watching it like a hawk.
That's why I have a model. It's because I'm an idiot. What do I know? I'm going to say, oh my God, this is so bad. Look at the debt, and the deficits, and the political environment, and blah 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 blah. I mean, I would have been sure if I've been doing this 33 years, mm-hmm. So I had to come up with a model that told me, when the market is ready to fall, not when I think it should fall. I'm going to tell the market what to do. Mm-hmm. My model tells me where it's heading. It tells me when it's about to happen. These are arcane components like we're just talking about. I mean, when credit spreads start to blow out, some idiot, no, every idiot on CNBS will come out and say, oh, it doesn't matter. It doesn't matter anymore. It's just this. It's just that sleeve. They'll start. No, I heard some, I don't want to get in trouble, but listen, there's no shortage of people coming on the mainstream financial media who tell you that it's different this time. It's not going to it's not going to be different. It's going to be the same function. Credit spreads will widen, and that's when you need to get defensive in your portfolio if you don't want to lose 30, 40, 50% of your portfolio or even more. Mm-hmm. And here's the thing, Tom. And I'm on record saying this. This is something very, very, very significant. The Fed is supposed to ride to the rescue, as they always do. The Fed funds rate right now is 5.25% to 5.5%. The effective Fed funds rate is 5.3%. The 10-year note is 4.18. If the Fed starts cutting rates, it has already been priced into the market. You are not going to get any relief for home prices, for the real estate transaction market. As a matter of fact, you might get the opposite, because if the economy starts to falter, people don't buy houses when their incomes go away. But what could happen and exacerbate the downturn this time is, instead of having yields on the long end of the yield curve fall as they usually do, they could actually rise because of, as you pointed out, we have an insolvent nation that has been ravaged by inflation. And when you start to try to inflate an economy, when you issue tons of debt in an insolvent nation, and you pursue a path of inflation in a nation that's already been ravaged by inflation, it doesn't really go that well. So the odds are that you're not going to get this big, huge plunge in yields this time around. Mm-hmm.
Michael, you mentioned your system, your framework that you use. Can you give us a quick refresher on the 4 sectors and what they mean? 5 sectors? 5 sectors. So there's it's based on, so I look at the rate of change or the second derivative of inflation. That's where I start with. So, and it ranges from, on the left side, sector 1 is deflation, there's disinflation,
there's stasis, there's reflation, and then there's stagflation, hyperinflation in sector 5. Those are the 5 sectors. I then ask myself, once I identify that using my model, I ask myself this question: what is the economy doing in relation to this condition of inflation? Is it a healthy economy? Is it a booming economy? Or is it an economy that's being ravaged by either inflation or by deflation? So that tells me what sector we're in. And then I ask myself a third question is, what is the level of asset prices? What's the level of the credit bubble, if there is one? If that informs me as to how pernicious or how devastating a deflationary collapse or the recession will the recession be a short, shallow one, or a deep one, or a depression? Well, the intensity of the recession, if there is going to be one, would be exacerbated by one that has huge asset bubbles and has huge encumbrance of debt, which is what we have today.
We touched on the fact that the yield curve has been inverted for the longest time in history. Do you see this duration of time creating even more distortions in the market? And what role does the amount of debt being issued at the short end of the curve have to do with this?
The yield curve has been inverted, and I've heard a lot of people say, well, you just alluded to it. Well, a lot of debt is being issued on the front end, which causes yields to rise, which causes the front end to be higher. No, listen. The yield curve is inverted for the longest duration in history. Now, the yield curve inversion is one of the best predictors of recession. I think since 1955, every single time it was inverted, there was a recession, except for 94, and that's when GDP went from like 10% to 0.2% in the mid 90s. So it always presages a crash in GDP, and maybe it's because, well, banks don't really lend a lot of money when their cost of funding is greater than what they can get from their assets. So it's kind of like it's predictive, it's self-fulfilling. And I don't think it's different this time. I'm raising my hand and telling you right now, put me down as someone who says it's not different this time. Inverted yield curve, which was the longest inversion in history, it was one of the steepest inversions in history, is not going to end well for this economy, period.
And do we typically get, when we cross back across that zero line, what typically happens at those points?
Well, that's usually when the yield curve reinverts or normalizes. Let's just say normalize. In other words, when short rates are below long-term rates. It usually happens when the Fed assents to the idea that, hey, we got a problem here. And they start slashing the rates. So they went from like 5.25 in 2007 to 0 by the end of 08. And so the long end says, oh, well, I'm going to go down a little bit because of a recession, because people are piling into that safety, but I'm not going to go down that far because, look, I'm not going to go to 0 because I know what's going to happen here. We're going to reflate the economy and yields are going to go up. That's normally the time when you want to sell your stocks, is when the yield curve normalizes, because the Fed is acknowledging that, hey, we got a problem. We're going to have a plunge in earnings, and that's not a good time to invest in stocks. And this is not happening yet. What's happening now is the yield curve it's still inverted, but it's like 20, 21, and 22 basis points inverted. And I guess it's the function that I was talking about. We have an insolvent nation that's been ravaged by inflation. So I don't think you're going to see the yield curve invert by 100 basis points. Once again, it's going to normalize, but it's going to normalize the same way it always normalized before. When the recession becomes fully manifest, the Fed is data dependent, Tom. They're dependent on data that is lagging. They are looking at labor market data, which is a lagging economic indicator. They're looking at GDP, which is a lagging economic indicator. My model, what looks at bank lending standards and the yield curve, the Fed's balance sheet, these are predictive algorithms to tell you where inflation is heading. I look at commodity prices, look at where inflation is heading. I don't look at what the CPI has done, reported in arrears from the prior month due to what happened months ago.
Mm-hmm.
I don't do that.
So exactly in that vein, Michael, I wanted to get your thoughts on if a crash in the stock market usually happens once the Fed actually acquiesces and does start to cut rates, and the stock market crash happens afterwards. And if all of this is because of these lags that are inherent within monetary policy.
Exactly. I mean, the Fed's always behind the curve. Look at the Fed funds rate right now. It's 5.25, 5.5, 5.3 effective Fed funds rate, and the 10-year note is saying, I know what's happening. The free market is telling us what's happening. Mm-hmm. Yields are at 4.18%. So the Fed's just be following the interest rates, which have already collapsed. There's no Tom, the Fed is comprised of labor market economists. I mean, they look at Phillips curves. So when too many people are working, that's inflationary. And when not enough people are working, it's deflationary. Mm-hmm. Nothing can be further from the truth. I mean, when people stop working and stop producing, there's less goods and services to absorb the money supply. So if you do look at history, there's actually no evidence that the Phillips curve actually works or has ever worked. But that's what they care about.
Right.
So, if we have problems in the labor market, which I think we will have, the Fed will start cutting rates. But again, that is a lagging economic indicator. The last thing people do and companies do now is they lay people off. They're worried, but they're hoarding labor still. I wouldn't be surprised if they had to companies acquiesced suddenly and they said, okay, I can't hold this labor any longer. And you see huge spike in initial claims and a huge spike in the unemployment rate, in the U3 unemployment rate. And then, then you're going to react. No, why don't you look at the money supply growth? Why don't you look at the level of the real Fed funds rate, which is positive for over a year after being negative for 20 years? Just look at that. That'll tell you where why don't you look at banks' balance sheets? Why don't you look at the inverted yield curve? That tells you where it's going. But even if the Fed said, okay, you're right, Mr. Pento, a recession's coming, we will start cutting rates. Cut them if you will, do the same playbook, but you might be unhappy with the results this time. Insolvent nations with an inflation problem don't tend to do very well when you pursue a course of inflation.
So if and when they end up taking that course, Michael, do you think the course of cutting rates and maybe going back to QE, do you think that is dependent on this point in time that we're at with facing the election? Do you think that ends up playing into part of their decision-making ability here?
Yeah, you got me real out of speculate. You have me speculating here, Tom. I got to tell you, I don't give a damn what that does. I don't care. I mean, if the economy was falling off a cliff and they didn't cut because they didn't want to seem like they were interfering with the inflection, well, that would be interfering with the election because they should really. I mean, I think the Fed. All right, so the Fed does lie. Powell is using mendacity many times. My opinion, when he says I care about the country, I care about the people, this class of people, or I care about the poor people. If you really cared about them, Mr. Powell, what you would do then is hold interest rates steady because you would understand that inflation has eviscerated the middle class. That has rendered them, 25% of the middle class, 25% of this country. So 1 out of 4 people are choosing to put food back on the grocery shelf because they can't afford it. They're cutting back on food and medical care because they can't afford it. It's 1 in 4 people. Mm-hmm. That's a study done by the Federal Reserve, not by Michael Pento. They know what they've done. And you can't have a healthy economy and a and a viable nation if you have an unhealthy and sick middle class, because those are the people that actually go to work.
Mhm.
The poorest people collect from the government, and the rich people live off, dividend checks and rental income from their assets. It's the middle class that actually produces things in this country. They have to be happy and they have to be vibrant. So they are liars, and they use mendacity to care, because what they really care about, oh boy, they care most of all is banks and Wall Street. That's what they really care about, because they wouldn't even be thinking of cutting interest rates, because they would say, all right, inflation levels have already destroyed the middle class. They need to come down. Not that they need to rise at a level that's much higher than 2% from here. That's not what they should be saying. They should be saying we need to bring prices down, and not what they're doing. They're paving the way. They've told us many times, cuts are coming. It's been priced into the market, because at the end of the day, they know that the level of business debt to GDP, all-time high, collateralized loan obligations through the roof, private credit through the roof. So these are things that hardly even existed a decade ago. So FHA loans up 900% since the global financial crisis. FHA loans, if you don't know, are loans to people with low credit scores, and they put 3.5% down, Tom. 1 in 4 homes are owned by investors. This home price to income ratios are at 5.5. That's a record high. Should they be thinking about letting homes fall or rise from this level? They really care.
Mhm.
So no, they care about one thing, and that's Wall Street and banks.
So if and when we get this case where the Fed cuts, what does this end up doing to the value of the dollar if we enter this, let's say, this condition of deflation?
Well, the dollar's already been falling because it's losing its world reserve currency status. It's just that our other countries are not willing to park their currency reserves with a nation that could arbitrarily and capriciously confiscate their savings. So they just don't want to do that. So they're already moving away from the dollar. I think the dollar could rise for a period of time, as it always does, as carry trades are unwound, as the recession intensifies. But then after that, I think it's lights out. I think it goes out. I think it goes down against other currencies, and especially against hard assets like gold and base metals and energy.
Mhm. So, Michael, going back to your model, I believe we're in sector 2 right now, right?
We're straddling 3 and 2. So it's the rate of change. The rate of change second derivative is sort of either static or falling. I think we will be in sector 2 very shortly, though. The 2, then it depends when you ask me, but we were in sector, for a while we were in sector 3, which was reflation, and then we went to sector 2, which was disinflation, bounced back to sector 2 and sector 3 and 4, and now we're heading towards sector 2. So it does change.
Mhm.
And it makes a difference, though, because there's different assets do better you don't want to overweight bonds in sector 3 sector 4 and 5. You want to be out of the bond market completely and short it, but you want to be overweight bonds in sectors 1 and 2.
Mhm. Well, that's exactly what I was going to ask. Being an active money manager, when your model tips into sector 2, which is disinflationary, right? What assets do you end up, seeing as most attractive in that
So
time?
it's bond, and it's just simple answer is bond and bond proxies.
Okay.
So treasury bonds, corporate bonds, low beta stocks, utilities, bond and bond proxies. Bond proxies are equities that act like bonds,
Mhm.
i.e. or e.g. utilities.
So is there not a place for metals in there as well, as you see it?
100%. So gold loves gold, not commodities.
Mhm.
Gold, which is not a commodity, it is money. It is a currency. Gold loves sector 2. Gold loves sector 1, 2, and 5. It does not love. Gold hates sector 4.
Mhm.
Gold loves sectors 1, 2, and 5 as long as one is in a liquidity crisis. So in a little liquidity crisis, gold gets dumped like everything else. Everything everything and anything that can be sold for dollars in a liquidity crisis gets sold. And gold is, either commercial banks or shadow banks. They just dump whatever they have.
Michael,
Investment banks.
when we consider basically, I've heard before that energy is basically equal to GDP. And if we have an economy that is so dependent on energy, is there a role in your portfolio or a time when you're favoring energy or wanting more of it?
Yeah, sectors 4 and 5. So I eschew commodities in sectors 1 and 2. I overweight them in 4 and 5.
Okay.
We're not there. We're not just not there. So I'm out. I would be out in short commodities in sectors 1 and 2.
Because sectors 4 and 5 are typically more of a growth.
Yeah. So you have health.
Phase?
You're growing the economy and destroying the currency.
Mm-hmm.
So you go into base metals and energy.
Mm-hmm.
It could be a healthy growth. Like I said, I described my model. I look at the second derivative of inflation. Then I ask myself, is that inflation, deflation dynamic healthy or unhealthy?
Mm-hmm.
That tells me for 4 or 5, the intensity of the inflation. So you might have in sector 5, usually have intense inflation with low growth. So that's, it informs me what to own.
Right. So Michael, you and I have gone over before kind of data that you see coming out that is either troubling to you or, could be a catalyst for the market. So as we look ahead here through August, September, maybe even October, what events and or data sets come out that you're really watching that could prove to be some type of a catalyst for the markets here, one way or another?
Well, I really focus on financial conditions and credit spreads. So they're very predictive of what's going on in the globe in general. So you look at initial claims, the liquidity it's available in the money markets. When you look at financial conditions, those are things I myopically focus on to let me know when it's time to I don't have any shorts, but when to start to get short the market. So right now, believe it or not, I might not sound bullish, but I've been bullish since basically Q2 of last year after being bearish in 2022. Bullish, Tom, in a allocation perspective, bearish on the fundamentals of this country. The fundamentals of the country is people think, he's a perma bear. No, I'm not. I was a perma bear, I'd be permanently out of business. Been in business 33 years. So I've been very, very bearish on this country and its fiscal and monetary policies and what they will lead to. Mm-hmm. That's what I'm bearish on. But that does not always mean, it sometimes means, but doesn't always mean that I'm positioned bearishly in my portfolio.
Right. I spoke with Danielle DeMartino Booth recently, and she was telling me about the revisions to the job cuts.
Right.
Is that something that you're watching as well?
Yeah, I'm also part of the financial conditions is the labor market. So I'm myopically focused on initial claims, revisions, unemployment rates. Most of the things I just mentioned are lagging. So I do a focus on them, yes, but initial claims is probably the most current of all those things I just mentioned. Okay. Unemployment rate is not something I've been myopically focused on. Mm-hmm. So forgive me if I misspoke there, but there's nothing more important than financial conditions and credit spreads when it comes to timing for the market. Now, most people will tell you that when those things start to when they stop being quiescent and start causing problems, they'll say it's just temporary because most people are in this business are just salespeople. Mm-hmm. They just tell you buy and hold because nobody knows what's happening with the market. Well, I can't do that. That I can't justify charging a fee and then telling people to buy and hold, because then you could just buy the SPY and maybe the TLT bonds and stocks and just go to bed, and just alter that depending on your age. I mean, I have, and I believe I have the ability to understand when asset bubbles are bursting because of the liquidity, when the liquidity gets shut off, and when we're heading into a recession. And I could alter my allocation, taking in commodities, high beta exposures, and going into a more defensive posture. I don't think there's anything wrong with that. Do you?
Not at all. Well, I think, again, back to the point of being an active manager and having a framework or a model to understand each of these conditions and what you want to own in those points of time.
Critical.
I think that couldn't have said it better myself, Michael.
Critical. I mean, what are we doing? I mean, you know what I don't get, Tom? Here, let me get myself in a lot of trouble. I don't understand I don't really like Wall Street that much. I used to work on the Florida Stock Exchange. Maybe that's why. I don't understand why anybody pays a money manager a fee who just buys and holds something. If you're just going to tinker around the edges, like there's people on CNBC who say, I'm always long. Well, if you're always long and 80% of managers don't beat the S&P 500, just buy the S&P 500. Mm-hmm. You could you don't care that the S&P 500 loses 50% of its value. Often, like 2008, goes down 30% in 19 to don't forget, we started that crisis before COVID. 2022, when you don't mind losing 20, 30, 40, 50%, if you don't mind that and you're okay with it and you're young, then just go buy the SPY. But if you're like me and you understand that you don't have the time to go down that huge portion of we don't give that back, because there is no guarantee it just bounces back this time. I don't know if I made this point clear, but this time around, because of the inflation and insolvency conditions in the United States, there's a good chance that long-term rates rise instead of fall. And then that's usually the salve behind a recession. Recession brings rates down, causes asset prices to fall, debt levels to be pared down, and everybody's happy. Mm-hmm. But what if they go higher this time? If prices drop and yields spike, and it costs you more money to buy a house? I mean, what is that going to do to the housing market and the banking system? So,
again, kind of comes back to liquidity, and that I think ends up, as you say, creating all of those secondary effects through the derivatives and the credit markets, everything.
Yep. Yeah.
Excellent. Michael, I want to thank you for your time today. I know we had a bit of a short window here today. Of course, all of your newsletters and I believe it's twice weekly podcasts, right?
No, the podcast is called the Midweek Reality Check. Yep. It comes out once a week on Wednesday night. And you can get that on my website. It's $50 a year. You get all of the salient data that I look at and my unbiased interpretation, because that's all I actually care about, because I don't sell anything. I just want to know how's my money best allocated, because my money's in my own, I eat my own cooking here. Mm-hmm. So and if you like the podcast, and if you think you have an interest in investing with me, it's $100,000 minimum. You're a U.S. citizen. I will put your money myself, manage it in the IDEC portfolio. Inflation, deflation, economic cycle model.
Excellent. And that's all available at pentoport.com. And of course, on Twitter at Michael Pento. Michael, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.